Good day, everyone. So, in this video, for today's video, I'll be discussing sa continuation aning consolidation of financial statements. So, again, this will all be theoretical, and some focus will be the elimination of unrealized profit on intercompany sales. So, hindi lang sa inventory, but we will also tackle on property, plant, and equipment. So, let's start immediately. So, as an introduction, affiliated companies may make intercompany sales of inventory or other assets. The term affiliated group is used to refer to a parent and all subsidiaries for which consolidated financial statements are prepared. Alternatively, this group may be referred to as the economic entity or as the consolidated entity. And the sales from a parent company to one or more of its subsidiaries are referred to as downstream sales. Sales from subsidiaries to the parent company are referred to as upstream sales, and sales from one subsidiary to another subsidiary are referred to as horizontal sales. So, what as a summary lang aning paragraph, the entities comprising the parent and the subsidiary are called one entity. So since they are one entity, any transaction between them, if na ay gain or loss, is must be eliminated. Kayo are just gabaligya lang kasi yung pagalingon and feeling na mo kinakakita. So that will overstate your sales and it will make your company falsely reporting your sales. So it will be like lying to your owners or shareholders. Therefore, yan ang importante ang elimination of intercompany sale. Ordinarily, the selling affiliate will record a profit or loss on such sales. From the point of view of the consolidated entity, however, such profit or loss should not be reported until the inventory or other assets acquired by the purchasing affiliate have been used during the course of operations or sold to parties outside the affiliated group. So profit or loss that has not been realized from the point of view of the consolidated entity through subsequent sales to third parties is defined as unrealized intercompany profit or loss and must be eliminated in the preparation of consolidated financial statements. So what sa atong tanggalan diri no is that the unrealized intercompany profit or loss. And para nga ma-recognize na siya, those assets must be sold to a third party. So what are the effects of intercompany sales of merchandise on the determination of consolidated balances? So this topic is designed to accomplish the following financial reporting objectives in the consolidated financial statements. Una, the consolidated sales include only sales to parties outside the affiliated group. So hindi kasama ang sales to the affiliated group or sales to affiliate companies. Consolidated cost of sales includes only the cost to the affiliated group of goods that have been sold to parties outside the affiliated group. So, dapat yung cost of sales ay at cost, hindi at sale price. So, ganito ka-importante ang elimination entries, and the consolidated inventory is recorded at cost pa rin. Hindi yung magkano siya ibinenta sa ibang affiliate members. So that's the goal of elimination. The sales, the cost of sales, and the inventory are valued at before the sale to the affiliate member. So, stated in another way, the objective of eliminating the effects of intercompany sales of merchandise is to present consolidated balances for sales, cost of sales, and inventory as if the intercompany sale had never occurred. Okay. As a result, the recognition of income or loss of intercompany transaction, including its allocation between the controlling and non-controlling interests, is deferred until the profit or loss is confirmed by the sale of the merchandise to non-affiliates or to outsiders. So deferred siya. Hindi mo muna siya i-recognize. I-recognize lang mo siya kapag na-sell na siya sa outsiders. So the determination of consolidated sales, cost of sales, and inventory balances. So we can recall that the cost of sales is computed as number one, beginning inventory. Add your purchases, your net purchases. You will get your cost of goods available for sale less your ending inventory. You will get your cost of sales. Now, depending upon the accounting system used, a given company may have a single account in its general ledger entitled cost of sales or cost of goods sold and single line on its working paper or alternatively separate accounts. So depende na yun sa company kung isang cost of sales lang or i-separate niya talaga ang beginning inventory, tsaka purchases, tsaka ending inventory and cost of sales. So in the preceding examples, the amount of intercompany profit, so the examples ni siya in the book, the amount of intercompany profit subject to elimination was calculated on the basis of the selling affiliate's gross profit rate stated as a percentage of cost. So recall that gross profit may be stated either as a percentage of sales or as a percentage of cost. So when it is stated as a percentage of cost, it is often referred to as markup. So to calculate the amount of intercompany gross profit to be eliminated from ending inventory, be careful to distinguish between percentage stated in terms of sales versus cost of sales. So yan ang dapat nga tundong mo na to. What does the problem say? Did it say it is in percentage of your sales or a percentage of your cost of sales? So be careful with that because different ang pagka-compute ana na profit or kanang markup. Okay. So both current and past GAAP require 100% elimination of intercompany profit in the preparation of consolidated financial statements. So, meron kasing dalawang approach to elimination entries ay partial and 100% elimination. So, first, ito sa partial. The partial elimination kay magbali sa okay, ano na lang sa 100%. Sa 100% elimination, tanan gid nga sale nimo to affiliate companies nga naay profit kay imo siyang eliminate bisan pa og naay non-controlling interest case na ang 100% and mo na siya ang ginagamit nato all no but i-treat yun mo siya as one company bahalag na ay non-controlling interest so you eliminate all now sa partial manggod na elimination i-eliminate nimo ang all except tong share sa non-controlling interest bali although nag-transact ka within your group lang kay since daw ang concept niya kay kana nga profit kay naaman daw share ana ang mga non-controlling which is kumbaga ma-consider sila as third party then imo tong i-recognize ilang share of the profit as profit pwede mo siya i-eliminate. So that's the theory behind the partial elimination, but we do not use that. And because past, the current GAAP and FRS are silent in this regard, we do not elaborate on the alternative of partial elimination. So silent ang GAAP and FRS about partial elimination. So the following items should be properly noted. Okay, okay, naulahi ang share. So under the 100% elimination, the entire amount of unconfirmed intercompany profit is eliminated from consolidated net income and related asset balance. So 100% tatanggalin mo ang intercompany profit. This approach is particularly logical under the proposed view of consolidated financial statements based on the entity rather than parent concept as required by PFRS 10. So as mentioned ako kanina na we assume that the whole entity is just one entity. So dili siya nga dahil lahi siya nga entity nga na parent nga like itag-iyahan ninyo yung mga subsidiary. No, when you consolidate under this assumption in PFRS 10, kani silang company, they are not different. They are just one. balag na ay ownership from outside party. Okay? So kumbaga, i-consider lang to sila as other shareholders of the company. Whereas the parent concept, kay nag-ano siyang na ay mga na father, and then kumbaga sample lang niya pag adapted niya ng mga tao. So meaning if na ay outsider kay kumbaga kaning mga ano okay, that's really difficult example. For example no, kaning 100% na kay father and kumbaga yung mga subsidiaries nimo kay mga anak nimo. So under the entity concept, if na ay mga other kumbaga nga mga entities nga nag-own na nila ng mga anak, then we are one big family. Bala hindi po kadugo anak. But under the parent concept, kadto sila nga mga other nga nagtagiya sa bata or other guardians kay they are not part of the family. Yan na ang parent concept. Okay, so that's a really. I hope you understood my example. So the amount of intercompany profit or loss to be eliminated is not affected by the existence of a non-controlling interest. So kung balik-balik, dili siya affected because of the non-controlling interest. The complete elimination of intercompany profit or loss is consistent with the underlying assumption that consolidated statements represent the financial position and operating results of a single business enterprise. Okay, single. Okay, so let's discuss the types of sale in an intercompany transaction. So there is upstream sale of inventory and downstream sale. So when an upstream sale of inventory occurs, the inventory is resold by the parent to a non-affiliate during the same period. Okay, and the inventory is sold to the affiliate. Okay, if nabaligya ra daw during the same period, the entire parent's cost model entries or even equity method and the eliminating entries in the consolidation work paper are identical to those in the downstream case. As I've mentioned kanina sa introduction, downstream sale kay parent to subsidiary and upstream sale is subsidiary to the parent. So the only difference between upstream and downstream profit is when the inventory is not resold to a non-affiliate. So sa first nga paragraph na ingan dito nga ini sa eliminating entries daw, same rang downstream ug upstream if nabaligya ra dayon ang inventory during the same period. But if not resold daw, a non-affiliate before the end of period work paper eliminating entries are different from the downstream case only by the apportionment of the unrealized intercompany profit to both the controlling and non-controlling interests. So why is that? Yan ang lahi sila. Okay, apportion daw. Okay, so the intercompany profit in an upstream sale is recognized by the subsidiary and shared between the controlling and non-controlling stockholders of the subsidiary. So upstream sale manggod, the subsidiary selling to the parent as a profit. Now, kadang ang profit kay shared siya sa parent o sa non-controlling interest. So, mana nga imo siyang ang realized profit. Okay, so that's for an upstream sale. But for a downstream sale, no, dili siya needed because wala may non-controlling interest ng parent down to the subsidiary, wala may non-controlling interest ana because the parent itself kay wala ga control sa iya. So simple elimination or recognition kung nasold na siya to third parties. Therefore, the elimination of unrealized intercompany profit must be reduced by the interests of both ownership groups each period until the profit is confirmed by the resale of the inventory to an affiliated party. or an outside party. So mura gid ni siya ang makapa-recognize sa ilaha sa profit. It is when it is resold to a non-affiliated party. Okay. So the determination of the non-controlling interest in consolidated income or manitong NCI in CNI, intercompany sales of inventory necessitate adjustments to the calculation of the distribution of income to the controlling and non-controlling interests. So whether the adjustments directly affect the non-controlling interest or only the controlling interest depends on who the intercompany seller is. Okay. So nagibalik lang no na if the seller is your subsidiary to the parent, then you must take into effect the unrealized in a sale or unrealized gain and profit, unrealized profit from the non-controlling interests or the controlling interest. So dili siya eliminate nimo siya separate trigger. Asa diri ang realized and asa ang unrealized. On the other hand, if the seller is the parent, then ang income man sa parent ang nag-need adjustment. So dili na siya i-separate kaya wala may non-controlling interest ang parent. Only the subsidiary has a non-controlling interest. Okay. So under the cost model of presenting your investment in subsidiary, so in the past chapters, the calculation of consolidated net income and retained earnings were refined to accommodate the effect of amortization, depreciation, and impairment of differences between fair values and book values. Ang wala siyang focus sa consolidation, elimination entries. But these must be further refined to accommodate the effect of unrealized intercompany profit. So the unrealized intercompany profits. So the non-controlling interest in consolidated net income is calculated as, okay, after subtracting, okay, na-mention na nila, na-discuss na nila earlier, compute sa NCI, after subtracting end of year unrealized intercompany profit and adding intercompany profit realized during the current year. So the net income is reported by the subsidiary. Okay, so una i-deduct ni mong unrealized intercompany profit and add ang mga realized. Now, if the sale of merchandise had been downstream rather than upstream, the amount of subsidiary income included in consolidated net income would not be affected by work paper entries related to unrealized intercompany profit, and no adjustment would be necessary in the calculation of the non-controlling interest in consolidated income. So, ibalik lang no na walay effect if downstream siya because it's the parent selling it. So consolidated net income is the parent company's income from its own independent operations. Okay. Isa na siya nga component sa consolidated net income that has been realized in transactions with third parties. So only those realized with third parties. So dili included ang mga sa subsidiary. Okay, plus or minus subsidiary income loss that has been realized in transactions again with third parties. And then plus or minus adjustments for the period relating to depreciation, amortization, and impairment of differences between fair value or implied and book values. Okay. So na ang sa consolidated net income. Now, under the equity method, which is actually easy if nag-equity method yung gigamit. No? In applying the equity method, the accounting objective is to report the subsidiaries' investment and investment income reflecting the close relationship between parent and subsidiaries. Diba under equity method, you will be recording the income of your investee. Income niya, you will record as investment income, and it is an addition to your investment in associate or subsidiary. And any dividend is a deduction to your ownership. Muna siya nga, consolidated financial statements are the same whether or regardless of whether a company uses the cost model or equity method. So same ra siya ang imong consolidated financial statement. However, the working paper eliminations used in both methods are different. As illustrated in this chapter, in the chapter of this book, and under the succeeding chapter, sunod different siya. Because the amounts in the consolidated financial statements in the books of the parent company under the equity method ensure the following aspects. So una, nganong kuan siya, because in equity method, the parent company's net income as reported is exactly equal to the controlling interest in the consolidated net income on the consolidated financial statements. So, okay, sa imuhang net income kay ano ni siya because you will not be uh, so realizing any intercompany profit because maapektuhan na nimo ang imuhang mo record ramang kapag na ay declaration of um, income, so as investment income. Then the parent company's retained earnings is exactly equal to the consolidated retained earnings on the consolidated financial statements. So wala na yung movements yung retained earnings andi kay imo namang girecordaan yung retained earnings through your investment in the subsidiary. So kumbaga na-appeal na dito sa imong investment sa subsidiary, na-appeal na dito ang sa imong subsidiary dito sa imong retained earnings because you use the equity method and even the common stock is equal to the consolidated common stock if you're using the equity method. And the appearance, even the paid in capital is also equal. And also the dividends declared is equal on the consolidated financial statements. So, anong inanim man siya? So, it's because ang equity method is already the net assets na of your of your of your subsidiary. And the ano and these items that are affecting equity are reporting na at the total na sa inyong sa whole group, but gi-separate lang tayo sa subsidiary as investment in subsidiary using the equity method man different ang ilang elimination entries. So as inyong book solving part ana or journal entry part. So okay. So under the equity method, the consolidated net income is the sum of the following components: the parent company's net income that has been realized, plus or minus the reported subsidiary income, and plus or minus adjustments to depreciation, amortization, and impairment. Okay. Under the equity method, so same ra to na sa consolidated net income. Under the equity method, no formal calculation of the controlling interest in consolidated net income is needed because the parent company has already made adjustments for realized and unrealized gross profit depending upon whether or not such profit has been confirmed through transactions with outsiders. So the controlling interest in consolidated net income equals the parent company's recorded income. Because, di ba, pag nanay share, pag ang share sa income sa subsidiary, imo siyang i-recognize as investment income. So madugang na siya sa imuhang net income as a parent. So meaning katong imong income is already consolidated net income. So when the parent company uses the equity method to record its investment, the parent company share of subsidiary income, including any needed adjustments for intercompany profits since acquisition is already included in the parent company's reported retained earnings. Consequently, consolidated retained earnings are equal to the parent company's recorded complete equity basis retained earnings. Therefore, regardless of the method used in the separate financial statement of the parent, the consolidated balance is always the same. So it's the same. Ano na ang effect niya pag whether you use cost method or equity method. And the major difference na sa cost method, dili ka move, dili ka move ang imong balance investment in subsidiary, whereas equity method ka move siya. Diba? Every dividend, every declaration of income, therefore madugong rapod sa parent ang tanan. So that's why nani ang case sa equity method. Now let's proceed to intercompany sale of PPE. So the concern for inventory is yung downstream and upstream sale. But for sale of PPE, okay, and the affiliated companies often recognize gain or losses on sale of PPE. So they also may have intercompany sales as discussed earlier. So necessary po ni siya sa PPE. Okay, so intercompany sales of depreciable property like machinery, equipment, and buildings. So the realization is through the usage. The company may sell property or equipment to an affiliate for a price that differs from its book value. So in the year of the sale, the amount of intercompany gain or loss recorded by the selling affiliate must be eliminated in consolidation. After the sale, the purchasing affiliate will calculate depreciation on the basis of its cost, which is the intercompany selling price. The depreciation recorded by the purchasing affiliate will therefore be excessive from a consolidated point of view and will also require adjustment. So for depreciable property, sale of PPE, not necessary nung ayan na mo i-realize ang sale sa PPE pag mabaligya siya sa third party, but even the ang depreciation pwede nimo manam mag-realize to nga profit case na dili kinahanglan ma-sell sa third party. But if ma-sell to nga PPE sa third party, then you record in whole ang profit or intercompany sale, intercompany profit. Okay. So ang mahitabo mong good no is ang original cost niya. So let's take an example here. Right there. Okay. So from the view of the consolidated entity, the intercompany gain or loss is considered to be realized from the use of the property or equipment. Okay, mo na siya ang pag depreciable siya through the use ang niyang realization. Because such use is measured by depreciation, the recognition of the realization of intercompany profit or loss is accomplished through depreciation adjustments. So depreciation adjustments ang basis pag depreciable property, but for non-depreciable property, then it is through the sale to a third party. For example, land. So example niya dire, parent company sells property with a book value 4,000 to its fully owned subsidiary. And subsidiary company for 10,000, so na siya 6,000 again. Assume first that the property is non-depreciable land. When will the 6,000 be recognized in the consolidated financial statements? Kung daw? The answer is not until it is sold to outsiders. If the property is sold immediately by subsidiary company for 10,000, the 6,000 gain will be recognized immediately by the consolidated entity. On the other hand, if it is not sold until year 4, the gain will not be realized to the consolidated entity until year 4. So every year until year 4, mo siyang i-eliminate ng 6,000 gain or mo mo siyang unrealized. Now suppose instead katong gibaligya nimo is a depreciable equipment, same 4,000 ang book value and sold for 10,000. So when will the 6,000 gain be recognized in the consolidated financial statements? The answer might sure seem to be not until it is sold to outsiders. But pwede siya nga. If masold siya as outsiders in that year, then you can recognize it. But there are other ways also to record it. Record yung realization, and that is through depreciation adjustment. So on the books of the subsidiary company, depreciation expense is based on a purchase price of 10,000. So kay subsidiary, 10,000 niya to i-depreciate. But the book value or the original good and the correct nga value at it is 4,000 over 3 years po siya. So every year na 2,000 nga excess sa depreciation imong gina-record. Thus, the depreciation expense is adjusted downward. Consolidated income is increased to realize a portion of the gain each year. Meaning, tanggalan nimo tong 2,000 depreciation expense nga excess because dapat less than 2,000 ang kuan, lesser by 2,000 ang imong depreciation expense, but because of the gain, intercompany gain, then ang effect no, pag mugamay mo depreciation expense is an increase in your income. Depreciation adjustment in such a case is often referred to as gain or revenue realization through usage. Okay. So when there have been intercompany sales of depreciable property, work paper entries are necessary to accomplish the following financial reporting objectives. Okay, first, to report as gains or losses in the consolidated income statement only those that result from the sale of the depreciable property to parties outside affiliated groups. Same ra gyapon nga concept sa inventory nga if it is sold not to affiliated groups. And also to present property in the consolidated balance sheet at its cost to the affiliated group. So dapat at cost siya ma-present and not to the dili siya dito sa at price nag-sell siya sa affiliate company. To present and also to present accumulated depreciation in the consolidated balance sheet based on the cost to the affiliated group, same to the cost gihapon, and to present thus the depreciation expense in the consolidated income statement based on the cost to the affiliated group of the related assets. So at cost dapat na ang presentation ani nga mga items. Now, if there is a change in estimated life of the asset upon transfer, okay, what about these cases? So when a depreciable asset is transferred between companies, a change in the remaining estimated economic life may be appropriate. For example, the acquirer may use the asset in a different type of production or process. So pwede nga ma-change ang useful life niya tungod kay from this company, from your subsidiary, gamit kay siya. Pero pag baligyan ani mo sa imong parent kay di ka siya gamit, so medyo mataas niya ang useful life. So there's a possible change in useful life. So when there is a change that occurs in the estimated life, the treatment is no different than if the change had occurred while the asset remained in the books of transferring affiliate. So, sa mag-apply ani nga um, accounting standard is the change in accounting estimates. Okay, so accounting estimates are happen. So there's actually no unless kung I gain or loss, intercompany gain or loss, so may adjustment. So you just ano lang, there's actually nothing to change there. Okay, you just assume also nga inani na mugamay na ang iyahang kuan. Ang at cost nimo, you will recompute it also at the new useful life and also ang at sale price para makuha nimo ang i-deduct sa depreciation expense. Okay, the new remaining useful life is used as basis for depreciation both by the purchasing affiliate and for purposes of preparing consolidated financial statements. So, magamit na siya. Nadili lang sa consolidated financial statements but also for the purchasing affiliate. And in cases in which an intercorporate asset transfer occurs during a period rather than at the end, wherein there is no intercompany realized gain or loss, a portion of the intercompany gain or loss is considered realized in the period of the transfer. So when this occurs, the worksheet eliminating entries at the end of the year must include an adjustment of depreciation expense and accumulated depreciation. So what if the during a period ka nag-transfer? So ang kuan ra pud ani no is i- i-prorata nimo ang mga depreciation expense. For example, at the middle of the year, so of course dili pod ang whole year imong i-adjust the depreciation expense. Okay. So meaning pag inana sa imong depreciation expense ay ang half sa year wala adjustment, but ang half sa year kina siya adjustment sa depreciation expense. Kina man siya tunga-tunga sa year gibaligya. And diyan na pud ka nga year nga maglahi og computation sa imong depreciation expense. Okay? The amount of this adjustment is equal to the difference between the depreciation recorded by the purchaser and that which would have been recorded by the seller during the portion of the year expired after the intercorporate sale. So the concept here is that i-prorate nimo ang adjustment to depreciation expense kung kano saan nimo siya na transfer. So I think those are the major um, theoretical concepts with regards to intercompany sale of inventory and PPE. So I hope you've been listening sa discussion ni Ma'am Joyce, intercompany sale and of inventory and PPE, and also nalapan sa inyong book. So that would be all. Thank you for listening and have a good day.